Hello viewers, today we're doing an introduction and the basics of shares investment, especially in the local context in Singapore. Now basically, a share is a document issued by a company which allows the buyer to be one of the owners of a company. A share can be issued by a company which can be purchased from a stock market. Companies issue shares because they need extra cash to expand their business. To do this, they either need to borrow money from investors through shares or from banks and sell part of the company. You can then use the money in a new business venture or to pay debts owed to banks. When you buy shares, you assume part ownership of the company. The investment will rise and fall as with that of the company's value. If the stocks of the company soar in value, the investment will have high returns, and alternatively, the share value of the company drops, the investment will have negative returns. Shareholders will be involved in making key decisions during the annual general meeting of the company. Investors will try to buy when share prices are low and sell when share prices rise to a reasonable level. Share prices fluctuate up and down over time, and if one holds a good company's shares over a long period of time, like 10 years, the risk will be reduced to almost zero, and it's proven that the investor will make a good profit. Now let's move on to the advantages of investing in shares. Buying shares of good companies is a good way to counteract inflation. Many times the inflation rate is higher than commercial banks' interest rates, so keeping the money in the bank is actually of little use. Indeed, the rate of growth is far beyond the bank interest rate. You can also get dividends. This is the cash reward given to shareholders as part of a profit made by the company at the end of each financial year. It is declared at the annual general meeting, or AGM, of the company. The larger the units of your shareholding, the more money you will receive at the end of each financial year. There are companies which have yearly dividend policies. Your financial advisor should be able to tell you some of them. There are also bonuses. These are free shares given to existing shareholders of a company. Sometimes a company declares bonuses instead of dividends. Sometimes they'll declare both. For example, a man who holds 100,000 units offered previously would receive an additional 100,000 units free after the declaration of a 1-for-1 bonus, making his values of his shares up to 200,000 units instead. Lastly, there's capital appreciation. Prices of shares move up or down responding to the forces of demand and supply. But with time, a good company's shares will appreciate in value. For the investors of such companies, the capital will appreciate with time. Now let's look at some of the disadvantages of investing in shares. Sometimes there may be a crash in share prices, just like the financial crisis of 2007, 3.5 years ago. The share prices dropped immensely due to the fear factor in the market on hearing bad news. Sometimes companies go into liquidation or wind up, thereby eroding the investments of ordinary shareholders almost to naught. Another disadvantage is the cost. There are costs involved in buying or selling shares. There's a GST system in Singapore which imposes 7% of the administrative fees, security processing fees, and brokerage fees. For example, if someone bought 1,000 shares at $5 per share and sells them at $10 per share, there will be $100 profit for the owner of these shares. However, this is not the case. Considering a 0.275% commission charge, SGX admin fee, and the 7% GST imposed over the commission, the net profit will only be $4,926 instead. Well, this is the end of the video. We hope that you've enjoyed it. Shares are a popular and great way to invest. Do check out our other videos for more information about our other financial products.